About $6 trillion worth of options expired today, and it really messed with the values between some of these indexes and commodities and their underlying funds. So in other words, check out the S&P 500 SPX versus the ETF SPY. The differences were wild. You can also check out the differences between US oil and USO. Check out the differences between natural gas and UNG. We might have to wait until the end of the day for these values to come more into line with each other, or maybe even wait until Monday. We shall see. The good news from today was Iran's foreign minister said that Iran is ready for diplomacy. Now, I trust Iran as far as I can throw a brontosaurus, but we'll see. He apparently said that there was serious and respectful discussions happening today. Again, let's see. But if this is true, it could be downward pressure on oil prices and petroleum, so that is good for my short oil positions, yes, which right now are underwater. Here is US oil as of about 2:30 this afternoon. Again, still only making unconfirmed breakouts above $72.34 a barrel and above $70.30 a barrel. Where it really hurt me today was USO, the ETF that tracks US oil, was a lot higher today, and of course my short oil positions are based off of USO, not US oil directly, so that did hurt me today. Again, let's see if these come more into line by 4 o'clock today, or at least Monday. Natural gas down big on the day. This is good for my short natural gas trade. Now, UNG didn't fall as much as natural gas did today, at least by about 2:30 in this afternoon. But at least it followed down, as where oil was flat and USO was up. It was crazy. Anyway, natural gas annulling the unconfirmed breakouts that we saw yesterday. So here we are, at least as of about 2:30, still in that confirmed breakout on natural gas. Natural gas can run anywhere between $3.94 a cubic foot and as low as $3.66 a cubic foot, obviously being short natural gas. I hope it comes down. Let's see what happens. Watch these levels. Gold as of about 2:20 this afternoon, fairly flat on the day, and that does jive with the GLD, that fund that tracks gold. Still working the confirmed breakout above $3,320 an ounce. Yes, this week gold has floated lower as the dollar has floated a little bit higher. I still think that between the Fed meeting on Wednesday and some other indicators that the Fed all but said that stagflation is here, meaning we are having a hard time to get inflation down to 2%. Inflation is kind of sticky, maybe even ticking up a little in some cases, and they just said that GDP was slowing. They revised their growth down, so lower GDP and higher inflation is stagflation. That is a great situation for gold. I continue to hold my gold position. The S&P 500 is undergoing a neat little change that has just started to happen in the last few days here. So in the recent past, what we often had, not every day, but what we often had was the market would open a little lower and then chop higher all day long. Well, that has flipped recently, and recently we have had a market that opens about flat to higher and then chops down all day long. So pay attention to that. Let's see how long this continues for. On the S&P 500 SPX, my 4 points here are no different. They continue to hold. I say that the bear market rally top has been made, and we generally chop lower from here. I continue sharing with you all of these data points that show that the economy continues to slow. And here's another one. The number of highly paid tech jobs in San Fran and Silicon Valley are falling and are now at their lowest levels since COVID, June of 2020, according to wolfstreet.com and as reposted by the Caboculator. Do you think if the economy was strong that Silicon Valley would be laying off workers, my friend? Possibly a very bearish event coming to our stock market on July 31st. That's when the Bank of Japan, their interest rate meeting concludes. It's kind of like our Fed meeting that we just had on Wednesday. Japan could hike interest rates as their CPI, their inflation, CPI excluding fresh food, hasn't been this high since early of 2023. According to Inceptor News, The problem with this and the problem with Japan hiking rates is the return of what is called the carry trade, which is one of the events that really led the stock market to sell off in February. Meaning, as Japan's interest rates rise, their stock market could fall. So Japan could sell some of their US stocks to prop up their own stock market. Also, if Japan needs cash, well, if they increase interest rates when their version of the Fed meets on July 31st and they increase rates, that makes borrowing costs more expensive, and for them to generate cash to do business with, for businesses to run their business, for the government to run the government, what could happen? They could both sell US stocks to generate cash because their borrowing costs are going to be higher. So I get it. This is still about 5-6 weeks away, but watch for this late July. This is not investment advice, and if you don't know me, I'm John Crocker, professional investor, proud American, cigar lover, and owner of Crocker Capital, LLC.